Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
And if that guitar riff doesn't get you excited to talk about property, I don't know what will. Phil Tarrant, co-host of the Pure Property Podcast with Paul Glossop from Pure Property Investment. And this is a day I've been dreading for many, many years. Many years. And we said, you would have maybe back in the day before this podcast existed, but I had a guy on the show, on the Smart Property Investment show, telling me how great surfer he was, how he's never able to get a suntan because he's always covered under a barrel. That's what he told me back then. He also was a part-time property investor, part-time property investment advisor, but he had a book and he told me how good it was. It was called The Surfer's Guide to Property Investing, and he made me talk about it for about 2 years. And even now, when I sort of speak to him, if I don't mention, he still gets upset. He will tell me that it's the best-selling property book of all time. I need to check my facts. I know a lot of other authors around property, and they also tell me the same thing. But he has a new installment of the book, 5 years on, 6 years on. I remember actually when I did a podcast with him when he's celebrating the first edition, so edition one. And actually, a little side note, I did collect first edition of books. A Surfer's Guide to Property Investing. We went and had a good dinner, a good slapdash dinner in the rocks of Sydney. And I remember it was a really good photo we had of the sunset there down the laneway of a pub out the front of maybe the Captain Cook, I think it was. But and I asked him then, when will be the next book? And he said, when there's something new to write about. Well, it's a lot of water under the bridge since those times. One of the big shifts was the COVID pandemic. So he's updated the book, which is cool. And I gave it pretty good raps first time around. I get a lot of property books. I read most. I skim most of them, to be honest with you. I don't read them cover to cover, but I look through them, and it was pretty well structured. Detailed all the facts and figures that anyone would want to consider if they're investing in property, but also how to take action about it. So I've asked him to come in the studio on the Pure Property Podcast. Normally we talk about other stuff and speak to property investors, but because this is hot off the press, this is probably the first time you're hearing about this. A Surfer's Guide to Property Investment, second edition. The next wave, you guys have really thought hard about that.
It writes itself, Phil.
It writes itself. How to achieve your financial goals and lead your best life through property investing.
You like it?
I don't know.
Like the cover?
I don't know. The font's changed.
Yeah.
It looks
There's a few more.
the same picture.
Same picture.
Just
Yeah, I've
got
slimmed down a bit since then.
Have you?
No, I actually carry about the same weight, which is it's a good thing because it's actually me looking in the mirror about 5-6 years ago. I'm running about the same weight, I reckon.
Yeah, it's not too bad.
Yeah.
You got a little bit more.
Hairline's
purple.
a little bit more receding.
Yeah, you got a bit
then.
more purple on the cover.
Yeah, a little bit more purple. Flash it up a bit.
Yeah, that looks like. Oh God, I was just looking at that wave there. I'm going to have to say Cronulla somewhere.
It was, yeah, you're right. Yeah, there you go. Yeah, north side of Allura.
You know,
yeah.
And if you read the foreword to this, which I penned, I reckon, and I think, which is a sort of an update of the original foreword. I spoke about my surfing prowess, and I think by memory I said it was very average at best, but I still appreciated the analogy of surfing and property investing. I haven't been surfing a lot lately.
No,
Paul.
you haven't. Phil. I can attest
appalling.
to that, ladies and gentlemen.
Yeah, it's absolutely appalling.
Yeah. And you will make more excuses
when life catches up
the
with
older
you.
you get.
When life catches up with you. But so why'd you do it? Why'd you do a second book, second edition?
There's the writing a book has always been a very, very time-consuming process. And the challenge with writing books, and the reason why podcasts are probably so popular, is that they're much more dynamic than putting something in writing and saying, here's the facts of the day, here's what's happened when, here's what the outcome was. Because once you write it, you can't unwrite it. And Phil, you're in the publishing industry. You know it. Once it's written, and you can't unwrite things. Podcasts are a little bit more forgiving. And the challenge and the reason why, I guess, what you open with, mate, is that there had to be something more to write about. And, the first book took a couple of years. This book took a couple of years. But the beauty about what happened between that first book, that I started writing in around about 2018, that got published around about 2019, or actually started writing about 2017, got published around about late 2018, I think, from memory. And this second edition is obviously from 2020 to 2024. Man, there's been some things that have happened, right? Like it's and this is certainly not necessarily directly to the property market that's happened. It's happened globally. And within that, there was so much that I could have written about, and there's so much that we could have explored. The reality is, I think what's important, and what I thought was a really important message, was to essentially say, here's what happens, here's how it happens, here's what can happen in the future, but here's what happens as a constant, which is what happens to the property market, both good, bad, and indifferent. And this isn't just about passive investing. What we talk about more specifically is, what are the crux of buying residential, of what happens in the commercial space when money gets really cheap to yields? What happens in the development space when supply gets really tight and cost of materials and labour goes up exponentially? What happens to the demand side of things when you get borders cut off and you get no one coming to markets, but you also see that a lot of people then have to split out and not live in studios or single bedroom accommodation? What happens to the demand of 3 and 4 bedroom homes? Then what happens to when the borders reopen and you get hundreds, if not hundreds and thousands of people coming into this country in unprecedented levels on an annualized basis? There's so many things that we explored in this book which talk about the pros, the cons, and essentially what's the constant in the property investment game. How does property react to all these different existential shocks?
I'm just rereading my foreword of the book. It's actually pretty good.
Oh, of course you'd say that.
No, it's actually, it tells a bit of a story.
Did anyone expect you to say anything different?
Oh, no, well, when you do something very often,
do you want to maybe share some of those dulcet tones with your audience to
I won't read
give
it out,
a couple of paragraphs?
I reckon, I don't know, this book's 223 pages. You only really need to read 2 pages
One and a half.
in it. Yeah, VII and VIII in the. It's even before the content section, but it talks about the nostalgia of surfing, right? And surfing isn't just that the physical aspect of riding a wave, is everything that goes around it. Yeah. So there's a subculture, and there's it has its artifacts, it has its history, it has its sort of little cultural nuances is quite funny, and this is really talking about how, and for you in particular, I'd say less so me. It's like surfing is not really the catalyst of happiness for me, but it's something I do enjoy to do and I do it. But being able to do what you want to do by doing something else really, really well, that allows you to do what you want to do.
Yeah.
And that's this in a nutshell.
The analogy.
The analogy. And your analogy is surfing, but for a lot of people it could be something completely different.
100%.
And everyone's got whatever
poetry,
that is.
It could be fishing, it could be driving a race car. I don't really understand what a lot of people like to do, but again, those analogies are very similar.
Are you surfing much these days?
Look,
I know you're on a trip that I missed out the other week. But
yeah, absolutely. And you miss basically every trip that happens for a variety of reasons, typically because you just place zero importance on getting vitamin D these days, I think. Yeah. Hence why we're sitting in a very dark, uplit room at the moment. But yes, to answer the question, I still do. I mean, my office is by the beach. I live by the beach. I try to get in the water as much as I can. It's coming into some warmer months, so it's a little bit more alluring to get in there. My boy's sort of starting to nag me to get back in the water, which is always enjoyable as well. So to answer the question, I do, and I intend to do a lot more in the warmer months ahead.
Yeah. No, it's good. And what's the team think about the new book? Your team.
Well,
your team, they're going, it's a more it's the Pure Property podcast, Pure Property Propaganda podcast with Paul Glossop.
No, look, the beauty is, I mean, there's a few things in pure property investment that have obviously changed, and a few things that have changed quite dramatically since we've wrote the second book. And some of those things in particular is the team's grown, there's been more members that have come in, and ironically, a couple of my team members joined us realistically by understanding or reading my book way back when, and they kind of came to me and said, look, I actually read your book, and it wasn't the reason why I employ them, but I tell you what, it didn't hurt to give a few brownie points and a little bit of back scratching there. But look, I think the good thing is that they use a lot of this stuff in their day-to-day work, particularly my buyer's agent team, is that a lot of these fundamentals are really the things that drive our decision making, as well as drive us to have those ongoing conversations with our existing clients, talking about holding the line, talking about staying strong through the difficult times, through these higher interest rate environments that will no doubt invariably turn to lower interest rate environments, through to things like rental rises and how it works throughout the years. Because one thing we do, and we detailed really quite in depth in this book, is not just what happened in COVID, but what's happened in property, and not just anecdotally, but from a data perspective, what's happened over the last 40 years.
So we'll chat about the data in a moment, because I imagine it's probably significantly different. What, 6 years on?
6 years on, yeah. When we took, basically, we looked at data in 5-year blocks, and there's a new 5-year block between more or less 2019 to end of 2023, and that's sort of where the data stopped. And this is the irony, right? Like, you put it in writing, the data that I'm just rereading it now, the data from the last 5-year block, that's even changed since I wrote this. Not exponentially changed, but it's changed enough to know, and ranking different cities and how they perform over the years, and looking at how that changes every 5-year block, and people sort of becoming so consumed in whichever market they live in, thinking this is the market to buy and this is the only market I know. But this gives that 30,000 foot view to say, you know what, just take a second to have a look at what's happened, where it's happened, and what the averages are when you invest consistently.
So you're still with Major Street Publishing?
Correct, still with Major Street Publishing. So this book, just so anyone's aware, if they do want to grab a copy, they can jump to any of their major book companies, their bookstores. It'll be on the shelves as we speak. They can also order it online, typically by any of the big major bookstores. Hot tip, I'm still working on an audio copy for this one. Couldn't do it for the last one. That was more painstaking work, but there might potentially be.
Are you going to read it out, are you?
There might be a narrated audio copy that comes out sometime in the future as well. Not immediately, but that will be something that's in the works as well.
Okay. Well, I see you got your copyright there, 2024, and your moral rights have been asserted. That's very important.
They are. Not that you respect that.
Yeah, you've got to assert your moral right.
If you're new to property investing and don't know where to start, you can grab a free copy of A Surfer's Guide to Property Investing, where I detail the last 35 years of property investment data, including what's happened during COVID-19 and what you expect to happen over the next 10, 20, 30 years. In this book, we detail everything from passive investing, renovating, developing property, commercial assets, and much, much more. So grab your free copy today, jump on the link, and you cover shipping. We'll get it to you within the next week.
Welcome back. It's Phil Tarrant. This is the Pure Property Podcast, where I chat with Paul Glossop from Pure Property Investment. And today we're chatting about the new book, or the second edition of A Surfer's Guide to Property Investing, inverted commas, The Next Wave. So what's next? Now, I was sitting there thinking, there's a lot of property books out there. Mm-hmm. The fact that you're doing a second edition means that the first one was worthwhile.
Absolutely.
Why would I read this as a property investor over the umpteen other books out there?
Look, obviously I'm going to be biased in how and
of
what
course.
I say. But the reason why, I've read, same as you feel like I've read countless amount of property investing books, and from the classics of yesteryear, from Jan Summers to a lot of Margaret Lomas's stuff that came out, a lot of them become quite niched, and niche is good if you're interested in the niche. The challenge comes a lot of the time is that what I found was probably a lacking component in the property investment book property space, particularly in Australia, is talking about Australia as a whole and narrowing it down to particular markets over periods of time. And I found that it's not just about passive investing. It's not just about buying and flipping and essentially then figuring out how to make profit. It's not necessarily just about property development or commercial property or a range of other things that go with that. We explore all of those things. We explore them in depth. And the reason why it's over 200 pages is that there's a lot to explore. And I think really what I think is done really well in this book and encapsulate it is that you can go from start to finish. If you're a first-time property investor, get a really good grip on what's going to happen in the property market, where you should start, how you should think about financing, how to build the correct team around you, and how to execute. But you can also be a very sophisticated investor. And I've got, realistically, in pure property investment, we've got hundreds of investors now who are deemed to be sophisticated investors with north of 6 properties. And there is a lot in here that we are talking to those kind of investors about how to evolve their passive investment portfolio to more of an active investment, commercial investment, other types of investing that actually fits within this same book. So it's one of those books which I've intentionally designed and written to cover the full gamut. And I think it's done a really good job. And we sold 10,000 copies of the first edition. And I'm somewhat confident that we'll probably do something similar with this.
Wow. Imagine if you had that as an audio book the first time around.
Imagine. There would be no sales.
It would have been no sales.
Because they'll download the free audio book.
Download the free audio book. But I remember saying this the first time, and I did read the first book, to be fair. I haven't read this yet. I will do, and I'll give my true thoughts and sentiments when it happens. But I said it the first time, and I can still see here now, it's pretty well structured. There's 4 parts to it, which part 1 is finding the perfect wave. So essentially that's, for anyone, that's rationalising where you want to go in life.
Yep.
So these are the clues from it and how you can structure. Part 2 is before you paddle out. So that will be around preparation. Preparation is
correct.
everything, making sure your finance ready, making sure you know structures, knowing mindset, all that sort of stuff. And then you got picking the right line. So, surfing parlance for how you actually navigate the wave. Same thing applies. This is the tactical stuff of what you're doing to actually be successful. And that's probably where I'll probably concentrate a bit today. And then the last bit there, mastery, living your best life. So this is conceptual thoughts and discussion around what does wealth actually mean.
Yeah, and trying to figure out your why. Because that's a part which I think the reason why that obviously sits at the end of this book in particular, but also that figuring out your why, the why changes. For any investor, Phil, you started investing before you had kids, right? Before you were married, all these other things, massive changes to family and just generally what you valued in life. And the why, I guarantee you, probably when you first started buying property was completely different to what it is now.
I
Mine's
didn't really have a why. I just did it.
No, exactly. We were like, well, I know it's the right thing to do. I know it's going to make me more money than what I'll otherwise have by doing nothing or doing what I'm already doing. But now the why is very different. Now you probably think about, well, there's generational components, there's passive income, there's general interest in doing things that are active that actually tickle your mindset to say, look, this is actually challenging and I like it. There's a range of different things, but that's why that's probably sits there and is something that I try to cover those too, because I've morphed my way personally over the decades in why I invest and what I do with my investments personally. And I do talk a fair bit about my own investment story in here. Now, whilst it's not super detailed, because that does actually change, it does talk about how that's evolved and sort of what that's now become from an actual property investor myself. Yeah.
So how much have the numbers changed in the 6 odd years since between editions?
Well, I mean, a lot, if I'm honest. Where are we? Page 83, picking a location. We detailed those 5-year blocks over the last, since, what are we going back to, 1988. The last block that we took to get the actual factual data, 2018 to 2023. What we did is also look at the gross increase in that 5 years and then ranked the actual percentage increase on a capital city basis, which I think for some people will actually be really interesting because you see throughout the years that actually changes. The ranking from 1st, 8th over the capital cities changes dramatically. But what changed, and I think one big thing was this 5-year block saw effectively 46.2% average increase. So if you bought the average property in the average city 5 years in that block and bought it in 2018 and held to 2023, you got 46.2%. Now, what changed dramatically, though, is the order of that growth. And you see that compared to 2013 to 2017. You look at Melbourne's ranked 8th in that block, last out of all of those capital cities. The previous 5-year block, Melbourne was 2nd. The previous 5-year block to that again, Melbourne was 2nd. The previous 5-year block, Perth was 1st, Melbourne was 1st. There's some themes that you start to see here, and you start to see where value sits and where value doesn't sit. But one thing that I think is quite obvious when you look at those numbers is that the more affordable markets in particular in the last 5 years outperformed the more expensive markets. And there's a bit of an overall theme within this is that the price of money and the price of essentially life at a particular period of time dictates the price of property in particular markets too. And it's no coincidence that Sydney and Melbourne aren't necessarily the best performing markets in Australia over the past 5 years because money got exponentially expensive with inflation.
But you look at all those complicating factors of it, and anyone who was in the market from 2018 to 2023, right? So that 5-year block. So the most recent 5-year block. It says here the all capital cities weighted average was 46.2%. Everyone's going to go, that's crazy, right?
Yep.
But we've got to put this into perspective. People invest without too much of a historic view. They invest maybe within 5 or even a decade, right?
And they actually also, what I find is something that the older I get, and time moves really quick. You know, you and I are a lot older than when we first started doing this podcast. Is that people, they measure their success on 1 or 2 years of holding a property incorrectly a lot of the time as well.
Yeah, but you look at this, right? So I'll break down this 2018 and 2023. I'll go in a little bit of detail with it, right? So this is in order of the it's a growth. It's capital growth, right?
Correct.
Capital growth,
Real percentage capital growth, which has actually changed a little bit since then as well. Like the last 8-10 months has probably changed it, but it's still largely the same.
So over those 5 years, 2018 and 2023, Adelaide grew by 61.1%, Brizzy grew by 54.4%, Canberra grew by 53.3%, Perth grew by 43.5%. You can see that
one would have changed.
Yeah, that would have changed for sure.
Because that's done 30% this year.
Hobart grew by 40.7%. You won't see that in the next 5 years.
No.
Darwin grew by 38.2%. Sydney grew by 53.3%.
Oh, that one's...
Yep. 33.3%.
Yep.
Melbourne grew by 25.6%. So the all capital cities weighted average was 46.2%.
Correct.
So every single person's going to go, what a great time to be in property.
Yep.
Like, it's the best there's ever been, right?
Absolutely.
Let's go back to the period from 2013 and 2017. That number was 48.4%. So it was better.
Yep.
Right? If you go back 5 years prior to that, 2008 to 2012, and I was investing in that market, 12.2%. Not a lot happened.
No.
Comparative there.
No.
Darwin was the best performer at 36%. Hobart grew at 1.9%. Brizzy grew by 3.2%. And I remember I bought properties in Brizzy around 2013 onwards.
Correct.
And it wasn't growing at the speed of what it has been these last 5 years.
No, and that 5 year block was basically when you held that property and thought this is really doing not
nothing's
much.
happening here, right?
Yep.
So, but 2008 to 2012, it's only like all cities capital growth 12.2%. You know, it was pretty humdrum.
Yep.
I started to invest at the back end of that
Correct.
period. So I've had a decade there of 48.4% and 46.2%. It's pretty good. So 12.2%. But then you go, put this in a frame of reference, 2003 to 2007, the all capital cities weighted average was 53%. So better than the last decade that we've been in. From 1998 to 2002, 70%. 70% all capital cities weighted average. Now, that looks like it was lifted pretty high by Melbourne, who was 88.2%.
Correct.
So Melbourne grew by 88.2% in 5 years between 1998 and 2002. Very different stories to what we have today. So,
and you probably noticed that these numbers, they might look a little bit out of whack because you're like, oh, how does 70% work in that 98 to 2002 block? But it's all about, that's actually not necessarily dividing the 8 cities by the total amount of average growth. It's actually the total amount of transactions because obviously Sydney and Melbourne in particular obviously have about half of all annual transactions. So they're weighted a lot differently depending on how that goes.
And this data is from Property Investment Professional Australia, PIPA.
Correct.
So it's good. Yep. I'd rely on it then. 1998 to 2002, 70%. Jeez, I wish I was investing then.
Even Perth.
Look at Perth.
Look at Perth
41.6%.
2003.
But all those, then it didn't move for a long time after that.
Yeah.
Look at Perth there, 2003 to 2007, 139%.
In 5 years. Yep.
Yeah, and then the next 5 years,
exactly
4.4%.
Yep.
The next 5 years, 0.6%.
Correct.
So
and now here we are back on the growth wagon.
Yeah. See, right place, right time.
Yep.
For the people investing if they held it for 10 years, not a lot of fun.
Absolutely.
Not a lot of fun. 1993 to 1997, 14.8%. So again, you've gone from 14.8% for that 5 year block to the next 5 year block, 70%. Okay.
Correct.
Go figure. And 1998 to 1992, 55.8%. So the last two 5 year blocks that we have here, 2013 and 2017, and then 2018 to 2023, which is pretty much the decade I've been investing, 46.2% and 48.4%. You think that's great. There's been much better periods.
There has been. And there's been much worse periods.
And there's been much worse periods.
And I guess this goes back to why this book is that unfortunately you can't buy, there is no ETF that aggregates the 11 million properties that Australia has, residential properties. So you can't go and buy Australia in an ETF and say, I'll go get 46.2% in the next 5 years or the previous 5 years. Now, that's an average. Now, the reality is in that if you bought property in 2018 and you held it now in Brisbane, in Perth or in Adelaide, you'd be doing many more backflips than if you bought that same property in Melbourne, as an example, because the difference is exponential. Unfortunately, that 46% is not what everyone got. No. Some people who got double that, more.
Well, some people got a lot more.
Some people got a lot more. I know properties that I personally bought have done far, far, far better. And many clients that we bought have done far better than that because of making sure that the timing in those blocks is correct. One thing I would say, though, is that averaging out all those 35 years and actually looking at the average annual compounded capital growth over that time, when you do your actual 5-year block divided by the 35 years that this equates to.
What is it?
It's close to 300% growth. So it's 299 point something odd percent.
At a weighted average.
At a weighted average. If you bought the average property in the average market in Australia in 1988 and you held it to the end of 2023 and it got those averages right across the board, it's gone up by 299%.
So call it 300 for 300%, simplicity,
which
right?
is about 8.5% average annual compounding
growth. And that's an average as well. So that's compensating for all the bad stuff and all the good stuff.
Absolutely.
So if you're investing above the average,
potentially
there's
and that excludes yield. I guess what this doesn't talk about is yield.
Growth.
So if you talk about adding on another 4% yield to that, the actual cash on cash return becomes well into the double digits.
But then you sit there and just go, all right, well, so if you buy $1 million property today, in 30 years' time, it's going to be worth 3 times that. Based on that assumption. And you sit there and go, there's no way in the world.
Absolutely.
There's no way in the world that the average. Well, what's the median now in Sydney? Is what 1.2. So you're going to go. It's going to be like $3.5 million.
And it's funny, Phil, I was driving in here to this studio this morning, and I was actually thinking about some of this data as I was coming in. And you know what I was reflecting on is my childhood home, which for anyone who's listening, I grew up in Liverpool, southwest Sydney. When my parents at the time bought that property in 1981. It was the other side of the main road that we're on was acreage farmland, and that was city limits for Sydney. Yeah. That was literally city limits. And I know because the Inghams, anyone who knows Ingham's Chicken, they owned a huge farm which has since been rezoned and multi amounts of property developed on there. They had horses, their horse studs, because they were big into the horses. I believe they still are. But that was one of their horse studs. And I remember going there feeding the horses as a youngster. They paid $36,000 for that home in 1981. My mum has recently moved home, and that home was sold a bit north of $1 million. And you start to think back then, if I told my mum or someone told my mum and dad in 1981, in 40 years' time, this property will be worth $1 million, they'd be laughing at you. Yeah. They'd think you'd literally have missed your meds for that day. And the reality is that is far more growth than what we're talking about as far as average annual compounded growth. It's well into the double digits annually. But we're talking actually more conservative approach to that. And it's not just how property grows, but ultimately we factor in inflation in this whole time. Yeah. Things get more expensive. This is the reality of how inflation works.
So I sit there and I'm sort of vocal on a bit of a love-hate relationship for property. I like it when it's good.
Yeah.
I can't be bothered with it most of the time, right? And I think that's sort of a bit reflected.
And I think because you don't cash out, Phil, that's the other part, is you do become somewhat...
I sold some stuff recently, but
but then you've bought other stuff.
Then I bought other stuff.
And then you get the mortgage repayments.
Yeah. But when I sit there and I start developing a negative view to property, my way I quickly shift or manifest a different mindset is that I get out my capital growth calculator. Yeah, I can pretty much break it straight away.
Yeah.
But I normally do sort of capital growth. And I don't have a small portfolio. No. It's probably bigger than most. I normally sort of look at compounding growth at like 5% a year.
Yeah. We typically, when we're doing our strategies with clients, both new and existing, we'd usually try to estimate anywhere between 4 and 6% per year. Yeah. For me is a good, sound, conservative expectation.
Yeah. And that's not like in 1 year you go, oh yeah, it's all right. But the nature of compounding capital growth is, and if you don't really understand this, have a play around with it and you'll start thinking about property a little bit differently. Because normally you look at, you look at properties often in isolation of, hey, this property's got these problems, I'm going to do this with it. But when you start considering a property as part of a portfolio, and again, not, a sophisticated investor, six properties or so, the needle can move very quickly.
Absolutely.
It can move really, really quickly if you buy in the right place. And back to these points here, have an understanding of it's just not buy anywhere and probably will be good for you. Certain people are going to buy in the wrong spots and certain people are going to buy in the right spots in terms of if you're trying to achieve capital growth. Let's frame it around that, because a lot of people just don't really care about capital growth. This is a good lifestyle property, or this is where I want to live and raise children, right?
Yeah.
So I'm putting that aside, and that's all good, and I know that. But you want to be investing where your money's going to be doing the best work.
Yep.
And that's property investment in a nutshell.
Absolutely. And if I sort of go back to that, and there's a lot of probably no doubt first-time or potentially first-time investors who are listening to this, what I talk about a lot here too, and I guess what you've articulated there, Phil, is there is always going to be a benefit for your property growing quicker than the average for a shorter period of time, particularly when you're starting out, because ultimately what that does is allows you to potentially grab that equity and recycle it at a sooner stage. And we also grab some data from CoreLogic, because there is an annual pain and gain report that is released by RP Data CoreLogic on a regular basis. And that talks about the average amount of time you have to hold a property before you've actually made a gain or a loss. And that oscillates, but to be honest, that doesn't change much between 6 years.
Yeah.
And going back to your point there is that you can buy property and you can get the average. Now, that average might revert back to mean if you've had a really, really good 5, 10, 15 years, it'll revert back probably to that 6 to 8%. We try to be more conservative, 4 to 6%. But the reality is, for every single investor or anyone who buys and sells a property, regardless of whether owner, occupier, or investor, it still takes them 6 years to pay for the property, all the upfront costs, sell the property, all the sales costs to actually turn a profit. It's around that 6-year mark. So it goes back to, you need to be able to figure out how to better that. And there's certainly markets that will always better that, but also realize that property is a slow-moving vehicle.
Yeah.
Buy, be patient, because the patience part. And if anyone's a first-time investor thinking about getting started, but like, 4 to 6% on my investment doesn't sound like a great amount. Well, if you take your $100,000,
that's capital growth. We're not talking yield.
Correct. We're not talking yield, and we're also not we're combining the leverage component, because if you've got a 60 to 100 grand starting point, let's work off a 100 grand starting point, leverages you into a $500,000 property. 5% is 25 grand. Now, 25 grand on $500,000, yeah, it's 5%. Doesn't sound amazingly different. You compound that over 20 years, it becomes a big number. But even more so, do 5% on your $100,000. If you put that anywhere else that was giving you 5%, that's 5 grand. So if $25,000 growth on your $100,000 starting point is 25% increase on your investment. And then year 2, year 3, year 4, year so on, that's where the exponential difference is.
A lot of people don't look at it that way,
No.
right? Because they always set it against the actual value of the property rather than the dollars you put into it.
Or what else could I do with my money?
Yeah. And this goes to the point, of depending on what your strategy is. If that property is neutrally geared, as in it's not costing you anything, that's genuinely $25,000
And even if it's
your
5, 10
skyrocket.
grand a year negative, you still minus that off your
Well,
growth.
you're still 15 grand on 100, right? That's 15%.
Correct. And then next year more, and then interest rates potentially come down. Rent will exponentially, consistently increase as well, and that neutralisation of that portfolio will happen over time as well. And Phil, I mean, I know you've spoken about it on your own podcast many a time, on the SBI podcast. I've talked about it on the Pure Property podcast, where I started was with a really modest deposit, really modest. And I'm talking, I think at the time I had about 25 grand plus a first homeowner's grant that allowed me to get in my first property back in the day. You started with seed money. That seed money, whatever it is, whether it's 20 grand, whether it's 200 grand, then you realize, well, that started this, and now all of a sudden I'm controlling 50 million in property comfortably with a seed amount that started. And that can go exponential. And I get asked that question a lot by first-time investors looking to leverage and go to property number 2, or even property number 2 investors looking to go to property number 5 or 6. And they're like, man, that's going to be a lot of debt. And we go through it in the book here to talk about debt as a number. If you're looking at the millions and millions in debt that you hold, yes, it can be daunting and a little bit intimidating, but you realize that one common misconception with building a larger portfolio, and the theme of this book is to live your life, your best life through property investing, is that you can control, and realistically, the bigger your portfolio, the more diversified invariably it becomes, and actually the less risky it becomes, because you go from one property with one tenant, If it's vacant, that's 100% vacancy. 2 properties, 2 tenants, 1 vacant, that's 50% vacancy, so on and so forth. You can control 100 properties. And if the average vacancy is about 96, 98%, 1 property, 2 properties, 3 properties might be vacant a year, but you've actually got all these other assets which are actually tenanted consistently. Now, if you manage your cash flows, you control a much, much larger portion of the real estate market. And if it's leveraged correctly, you manage your cash flows correctly, that's where you get to the back end of you can exit with some really serious passive income as well as serious equity position at the end of the day too. But the common theme is that 10, 15, 20 years needs to be a benchmark to think that way as your minimum time frame.
Yeah, even 10 years, it's hard. Unless you're hyper-focused and that's all you do.
And lucky.
And lucky. You know, it's very hard to do it. You know, it's a 20, 30-year horizon. And that's back to the point, you know, you 300% growth in 30 years, it's got to give you choice towards the back end of it. Probably the biggest issue you're going to have is that how do you actually realise your equity gains or the cash flow without paying too much tax, right? That's the biggest issue most people have.
That's a good problem to have. Yeah. And I think for me, the biggest challenge for most is that you can look at it as far as 300% growth, and I look at my mum's example there, is that the reality, unfortunately, for most is that it's all in their own home. And unfortunately, that doesn't help their overall financial position. If anything, it can be a hindrance to their financial means when they get means tested if they're going down the pathway of pensions, etc. So the reason why, yes, principal place of residence is very important to most for security, etc. But if you don't extrapolate that across 1, 2, potentially 3 investments and you rely on your super, the chances of that doing the job for you at age 65, 70 and beyond, it's certainly not going to be a foregone conclusion.
It gets tough, and this is why you need sort of help and support. And you spoke here a little bit around having a good team and stuff around you. That's pretty important stuff. But I know most people, when they want to talk about property, they want to talk about actually picking the property and choosing the property.
Yeah.
It's a fraction of the process.
It is.
It's an important part of it.
It's a chapter in a book.
Yeah.
Yeah.
It's literally a chapter in a book.
That's why it's not how to pick the best market. That's certainly not what the job is that we have, is that everything about the book is also reflected in what we do at Pure Property Investment, is that, the property and the location are important, but they're certainly not the only things we consider.
What's going on in renovations these days? That used to be like the thing to do.
It was, wasn't it? It had a time in the sun, which
everyone was doing it.
It was wild. And I think the DIY component, people, I don't walk into many properties anymore, and I go through a lot of property for a living. I don't walk into many properties anymore and I'm like, this was DIY. Yeah. And I think as we've just become a little bit more accustomed to nicer things that are done properly. Probably 20, 30 years ago, and maybe even only 7 to 10 years ago, DIY was all the fad. There was multiple companies who talked about buying a property, flipping it, and turning a profit. There's 3 things that always, for me, and I've never really personally been a proponent to buy, renovate and sell. Potentially buy, renovate, revalue. Yes, different strategy, but buy, renovate and sell as a living. A, it's a job. But B, the actual cost of labour and the cost of materials. And if it was DIY, take out the cost of labour, the cost of materials itself. But then the biggest prohibiting factor in Australia, which has basically been there since this modern era of property in Australia has been around, is what it costs to get in and what it costs to get out of property. Yeah. And for anyone who's listening and is thinking about certain parts that are in this book, I actually detail that a fair bit in the buying, renovating component of a property strategy. And we go through the warts and all of how that looks. But from a numerical perspective, and to run some numbers, you typically need to make somewhere between 8 and 10% on a property to break even. And if you start doing your math on buying a property and thinking, I'll buy this for $1 million, I'll go tip in $100,000 and I'll do a really nice freshen up. You need to sell that property, not necessarily for 1.1 million. So it's your $1 million plus the $100,000 you tipped in plus 10% to break even, because that factors in your upfront stamp duty, your holding costs, your sales costs, and potentially it doesn't even really include your CGT, but let's include CGT in there as well, capital gains tax. So you have to sell that property for circa 1.2 or a bit more just to know that you've actually covered all of those costs before you've made money. Now, you start to think about, wow, that is so much money to risk. And even if you just talk about what money you need to tip in, you say a 20% deposit, $50,000 stamp duty plus the $100,000 in renovation, that's $350,000 of your own hard-earned cash or equity to go down that pathway when you say, well, that's for me. And that doesn't take into account your hourly rate, what it takes, how long it takes, all those other things. And you start thinking, man, renovating property for a living, it's a hard way to make money.
It's hard work. It's hard work. And I look at it and people always go, why don't you do more of that and renovations and developments and
I
stuff?
couldn't think of anything worse.
I just go, I don't want to do that.
No.
My time is better spent making money elsewhere.
Yeah,
right?
absolutely.
It's just go, and there's a lot you can't control.
Yeah.
Yeah. And you got to be all in, right? You got to be pretty gifted at dealing with tradies and all the nuances of that.
Yep.
So,
and that even speaks to, and again, going back to the other chapters in here, we talk about renovating, even developing property. And I've been very, very transparent on this show. A lot of the time, I develop property actively all the time. I actually had a really, really long meeting with an existing client of ours yesterday. And we were talking about potentially moving away from the passive side. He's got 7 assets that were bought over the last 6 or 7 years. They've done extremely well across 4 different markets. He's getting a bit bored, and that's probably the word. And he's like, I'm thinking about maybe take some money out and go and buying a dual lock site somewhere in Sydney. And I took some time to really use all of my expertise, and I loved it because it was kind of one of those moments where I flexed my muscle a bit and said, okay, let's just take a backward step. Here's what you've done over those 7 properties over the last 6 years. You've bought essentially 7 properties, average about $450,000 each. Let's call it about 2.8-ish million was purchase price. They've done. They're worth now about close to $4.5 million over that time. Really huge gains, right? And they're more or less close to cash flow and negative by about $25,000 a year before tax. $1.5 million equity gain after all said and done in 6 or 7 years' time. Going and buying a dual lock site, which I detail in here again, and I do this for a living as well on the side and look at it. So again, to run those numbers, anyone who's thinking about it, jump into the book and you'll grab a fair bit more detail there. But to run the crash course, again, let's talk about a dual lock site in Sydney, $1 million purchase price. You've got to then pay for all the upfront costs. Real simple math, and this is from decades and literally over $100 million of investing into this space. I refine it down to this simple calculation. Figure out what you're going to sell these dual locks for. So let's say $1 million site. Let's say you're going to build 2 dual occupancies or duplexes. And let's say you're going to sell them. Let's say you assume you're going to sell these things for, I'll go down the path here, probably something more realistic. Let's say it's a $1.5 million purchase price in Sydney, and you're going to sell each dual lock for $1.5 million. So $3 million gross actual realised value. And then you work backwards from there to say, if I want to make any kind of money, I've got to figure out what this is going to cost me. So 1.5 plus another, I'll be generous and I'll say $1 million to build a duplex, which is not achievable anymore, but let's say $1 million. So you bought for 1.5, you've put another $1 million in, you're at 2.5, you times that number by 1.1. It's kind of my secret. I kind of refer it to the same rule of the rule of 72, times that by 1.1. And that ironically, and this is not just for a dual lock site, this is for townhouse sites, everything else included. Once you times it by 1.1, it factors in about 30 different itemizations on a spreadsheet, which goes from surveyors to town planners to architects to holding costs to bank fees to Section 73s, a whole range of different things. Times by 1.1, that'll give you a number. So on that same exact number there, you say, okay, well, I buy for 1.5. I put $1.2 million into $1 million into a dual lock. I'm at $2.5 million all in. Times that by 1.1, I'm at about 2.75 million to get to this end actual cost. I'm going to sell for $3 million. I'm going to cost me 2.75 to get out. There's $250,000 in it. That's before you've paid. Well, that includes things like agents' fees, etc. But that's before you've paid GST on sale. So there's a whole range of different things that you come into there. So
and probably factoring your time to do that.
Oh,
right?
It doesn't. I mean, I don't factor in time because that could be infinite, and depending on how much you outsource. But I guess what I'm trying to get at there is that even in that instance, which is realistically not actually an outcome that can be achieved to build a dual lock for $1 million anymore, developing property is a very, very niche way to make money. And it's similar to renovating. It's a job. And I really try to detail that a lot in here. It's not to say that I try to dissuade people to not do it, but I try to give the warts and all approach to it all. And the reason why I love a hybrid approach to what I do is that I do a lot, but I tell you what, the more complicated things that I do, I've done after getting decades of experience in doing the real simple things really well and being patient. Because the most money I've ever made in property is in the property that I bought first.
Oh, yeah. It's funny how that happens.
It's still the same.
It's funny how that happens.
Yeah. Hey folks, Paul Glossop here from Pure Property Investment. I am excited to bring you my second edition of The Surfer's Guide to Property Investing, where I walk through 35 years of property investing data. You can grab your free copy today. Jump on the link below. It'll be with you in the post within the next week.
Welcome back, Phil Tarrant. I'm chatting with Paul Glossop around his updated book, The Surface Guide to Property Investing, The Next Wave, available, I'm told, in all good bookstores. Can you get it at the aeroport?
You can.
We'll be there.
Yep.
Are you going to get all your people right throughout, and every single listener here, if you see this book, make sure you spread it across
copy.
everywhere.
Yeah, absolutely. Well, I'm happy for people to post it. Tag pure_property, our Instagram.
Get a free book there.
There'll be a free book, free plus shipping. I'll give everyone a plug right now. There's actually we've got an actual allotment. I've got 3 cases of books sitting in our office. 3 cases. I think in each case is about 45 or 50 books.
Yeah.
They've been given to us by our publisher for, I think it's about, let's call it, what's that, about 135, 150 odd books that are available in our office. People jump on our website, purepropertyinvestment.com. Opportunity to go to, I think it's under guides or book. There might even be a pop-up that finds your way. Free plus shipping. Shipping's about $8 or $9. There'll be a hard copy book that'll look like that.
Yeah.
That'll be in
like a real book.
A real book. Not this book necessarily, because it's a little bit bent, etc.
Yeah.
They can get it personalised by Philip Tarrant if they write a message and say, "Please get Philip Tarrant to personalise it." No, they won't, because they don't want it. You wouldn't really be audible or legible anyway. By what you write.
Chicken scratchings.
Absolutely. Yeah. But we've got about 150 books to give away. So jump on there, and you might also find us on a few other socials where there's a few free book offerings up to about 150 books before we charge the full freight of, what will that be? I don't even know if it's written on here anymore, but it'll be about $28 or $29 at your bookstores.
Wow, cool. What about if I'm old-fashioned, I just come by your office and go knock on the door and say, "Oh, can I save myself?"
Well, if you've got cash is king.
Cash money. Buy a cup of coffee.
Yeah, it's a cup of coffee, and I'll give you. Well, look, if there is, if those 150 copies are still available, a coffee.
A coffee.
Coffee. It'll cost you a coffee, but not potentially for me, but potentially for my team as well. There's quite a few of them in there, so if you want a coffee, that might be more expensive than actually buying the book at the bookstore.
And a Danish? What about a nice Danish or a sausage roll?
I'm not adverse to either of those options, but I think it becomes a little bit cost prohibitive unless I want to get it personalised. That might be an option there.
Come and get it signed.
Yeah,
that's cool. Yeah. So is this the end of it? Is this the last edition?
Well, Phil, we never say never. Never say never. But I'm stoked to get it out there because we've been talking about it for a long time, and it's taken. I mean, for anyone who's listening who has written a book, you'll know the pain, the suffering, and to do this as you go it's just there's so much you have to put into it, and it just takes time, unfortunately.
Maybe we should co-author a book. I don't want to write a book, but we get someone to ghostwrite it.
Yeah, nice one. what would that be on?
It could be on. What would be a good analogy that you could use?
You would still want to revolve it around property?
Property investment is like a good Chinese meal.
Okay.
You start with a good entree. Sometimes it's fried, depending how you feel.
Can't have too much fried. Steamed. Make sure you get a bit of steamed in there, because otherwise the fried, takes its toll.
It's like a fusion. How do you? There's so many.
The lazy citizen of property investing.
There's so many analogies for property, right? Like we've talked about them before, but no, well done.
Endless.
Congrats, mate.
Thanks, mate.
Good to see that come out. We'll have to go and celebrate it. Major Street, they're pretty invested in property stuff.
They are.
Good to see them out there.
A lot of good authors out there. Some of my colleagues have done a lot of good work with them. Some of the big names out there in property investing, in addition to this book as well.
That's cool. All right. So pureproperty.com.
purepropertyinvestment.com.
Yep.
They start there. They can just hover over. They'll be able to download their own free version. If they send us a message at inquiry@purepropertyinvestment.com.
E or an I?
E. So you send us an email via enquiry at purepropertyinvestment.com. Send your details. We'll send you through. Just say, hey, look, interested in a copy. As long as we've still got the free allotment, we'll send you back a link with the order form, and then essentially you'll be able to get it that way as well.
And it'll be posted out to you.
Typically within a week or two, as long as you're in Australia, as long as you're not over in somewhere in Antarctica and asking for a carrier penguin to get it there to you.
Well, for all those people who are really into property and they have a reluctant partner, it's a good stocking filler.
It is a good stocking filler. It's right time.
Just around the corner.
It is right time, right place. So feel free to use and abuse that offer and that opportunity, because they will run out and they'll be $28 or $29 at your good bookstore. But feel free to buy the full freight one too, because it helps me pay for the printing, all of the time that goes through all of this. I'm not averse.
Did you actually spend much time on it? Like, were you sitting there with your little...
2 years of going through the manuscript, back and forth, back and forth, back and forth. 2 years. It's a lot of time.
It's time well spent.
Yeah, absolutely.
Maybe.
You wouldn't know.
You wouldn't know. No,
No.
it's just us. Yeah. Anyway, thanks for coming in, mate. It's good
Thanks,
to see
Adam.
you. Remember, A Surfer's Guide to Property Investing. You'll know it because it's purple, and I don't think there's any other purple property books, so it'll be catchy.
Hopefully.
Get it on the way through when you're at the airport. Old school. I still read books. I probably still get through 3 books a week. And I'm old school like that. But thanks for tuning in. purepropertyinvestment.com. If you want to pick up on Paul's offer there, we'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.